Most investors focus on growing their money, but few realize how much they're losing every single year to taxes. Because even if you don't sell your investments, the IRS may still be waiting for its share. Dividends, capital gains, distributions, all of them can quietly reduce your returns if you're not prepared. Today, we'll uncover the truth about how investment taxes really work in the US and how smart investors use accounts like Fidelity's IRAs, Roth IRAs, and 401ks to protect their gains and keep more of what they earn. Welcome back to Invest Education Hub, where we turn smart investing into simple decisions. And definitely stay with us until the end. This explainer might save you thousands before the year is over.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's start with a real eye-opener. The impact of taxes, what people in the industry call tax drag, can be absolutely massive. A really detailed long-term study from Morningstar found something pretty staggering. On average, taxes can erase about 20% of a stock investor's returns. Now think about that. For every $10 you make, taxes could be snatching 2 of them. But for bond investors, wow, it's even more dramatic. Taxes can potentially cut returns by over 40%. These aren't just little rounding errors, They are significant costs that compound year after year, silently eating away at your wealth. So that's the big question, right? Where does all that money actually go? It's not like it just disappears into thin air. Well, it vanishes through a series of taxable events that, honestly, many investors don't even realize are happening inside their own portfolios. Okay, so here's our game plan. First, we're going to really dig into this hidden tax drag and uncover the taxes you don't even see coming. Then we'll switch gears and talk about how time, some smart tools, and strategic asset placement can seriously work in your favor. And we'll wrap it all up with a clear, straightforward action plan. So let's start with section 1. How does this hidden cost actually work? Well, it all starts with a very common and frankly very costly assumption that a lot of people make. So many investors believe you only owe tax when you hit that sell button and lock in a profit. And hey, if you only own a single stock, that's mostly true. But it is a hugely costly misconception when you start investing in things like mutual funds and ETFs, which, let's be honest, is how most of us invest. And that brings us to our next section, which is all about the taxes you don't see. Because in a standard brokerage account, you can absolutely owe taxes even if you never, ever sell. This happens because the funds you own are busy making their own moves behind the scenes, and those moves can trigger tax bills that get passed directly onto you. So there are really 3 ways you can end up with a tax bill from your investments. Number 1 is the one we all know. You sell something for a profit. No surprise there. But it's the other 2, dividend distributions and capital gain distributions, that are the real silent portfolio killers. They catch most investors completely by surprise because they can happen without you doing anything at all. Let's talk about dividends. When a company pays you a dividend, that's income. And here's the crucial point that trips people up. Even if you automatically reinvest your dividends to buy more shares, which is a great strategy by the way, the IRS still considers that cash as taxable income for that year. So you may never actually see or touch the money, but you still owe tax on it. Now, this one can be a real shock. Let's say your mutual fund manager decides to sell a winning stock inside the fund. Well, the fund realizes a capital gain, and by law, that gain has to be distributed to the shareholders. That's you. So at the end of the year, you get a statement showing a capital gain distribution, and with it, a tax bill you probably weren't expecting. This is what's known as phantom income, and it's called that for a good reason. It's income that appears on your tax forms but never actually lands in your pocket. And here's the most frustrating twist of all. You could actually owe taxes in a year where your portfolio's value went down, all because of the fund's internal trading. It's wild, but it's totally avoidable if you just know the rules of the game. Okay, so now that we know how we get taxed, let's not get discouraged. Let's see how time can become your greatest ally. The tax code actually, believe it or not, rewards investors for being patient. And understanding this one simple principle can save you a tremendous amount of money over the long run. The line in the sand drawn by the IRS is 1 year. The difference between holding an investment for 365 days versus 366 days can be huge. Seriously. Anything held a year or less is a short-term gain, and anything held longer is a long-term gain. That one extra day can completely change the tax rate you pay on your profits. And just look at the difference here. The tax code basically gives long-term investors a big thumbs up with much lower rates. Short-term gains get taxed at your ordinary income rate, which can be as high as 37%. Ouch. But long-term gains, they get these special favorable rates of 0%, 15%, or 20%, depending on your income. That is a massive, massive saving just for holding on a little bit longer. And guess what? This same principle applies to your dividends. To get that lower preferential tax rate, a dividend has to be qualified. This basically means you have to hold the stock for a certain period of time around its ex-dividend date. That's the cutoff for getting the next payout. If you miss that holding period, the dividend becomes non-qualified, and boom, it's taxed at your much higher ordinary income rate. Again, patience pays off big time. So now that we know the problems and the rules of the game, let's pivot to the solutions. It's time to open up our toolkit. These are proactive strategies you can use not just to react to a tax bill at the end of the year, but to actively manage and reduce it all year long.
Okay, nobody likes seeing an investment lose value. It stings, right? But tax loss harvesting lets you turn those lemons into lemonade. When you sell an investment for less than you paid for it, you realize a capital loss. Now, this loss isn't just a sad number in your portfolio. It actually becomes a valuable asset for shrinking your tax bill.
Let's walk through this example with Jordan to see just how powerful this is. First, Jordan sells an investment for a $6,000 loss. Now watch this. That loss is first used to completely wipe out a $1,000 gain elsewhere. The tax on that gain? Gone. Poof. Next, Jordan uses $3,000 of the remaining loss to directly reduce their taxable income from their job. And finally, that leftover $2,000 loss? It gets carried forward to offset future gains in the years to come. It's an incredible way to get multiple years of tax benefits from just a single loss. Now, beyond what you invest in, where you invest matters just as much. In fact, it might matter more. The type of account you use creates a completely different tax environment for your money to grow in. This isn't just a small detail, it's a foundational choice. Let's think about it like this. A standard brokerage account is fully taxable. It's like a greenhouse with a leaky roof. Every year, that tax drive gets in and slows down the growth. But a tax-advantaged retirement account like an IRA or a 401k creates a protective shield. It's like a perfectly sealed, climate-controlled greenhouse where your investments can grow without that yearly tax drive holding them back. Now, inside these tax-advantaged accounts, you've got two main flavors. With a traditional IRA or 401k, your growth is tax-deferred. All that phantom income, all those distributions, they all happen inside a tax-sheltered bubble. You only pay taxes way down the road when you withdraw the money in retirement. But a Roth IRA, a Roth is even more powerful. You contribute money that you've already paid taxes on, and then it grows completely, 100% tax-free. All qualified withdrawals in retirement are never taxed again, ever.
Okay, let's take this to the next level and combine our knowledge of assets and accounts. This brings us to a really key strategy. And listen closely, because I'm not talking about asset allocation. That's deciding your mix of stocks and bonds. I'm talking about asset location, which is deciding which type of account is the best home for each type of investment.
The strategy here is actually pretty simple and elegant. You want to shelter your least tax-efficient assets inside your tax-advantaged accounts. For example, bonds, which kick off interest that's taxed at high ordinary income rates, are a perfect fit for a traditional IRA, where they can just grow tax-deferred. Meanwhile, your more tax-efficient investments, like certain stock index funds that don't have a lot of distributions, are better suited for your regular taxable brokerage account. It's all about putting your assets where they'll be treated best by the tax code. Okay, let's make all of this really concrete with a simple plan you can review before the year is over. Because smart tax planning isn't a one-and-done thing. It's an annual checkup to make sure your portfolio is running as efficiently as it possibly can. You gotta remember, the clock is always ticking on the tax year, and the hard deadline is December 31st. Any move you want to make, from harvesting a loss to maxing out a contribution, has to be done by then. That's why the crucial planning window is really November and December. That's when funds start announcing their capital gain distributions, which gives you a final chance to react and make smart moves. So here it is, your year-end checklist. First, review your funds for those upcoming distributions. Look for opportunities to harvest some losses. Double-check your holding periods to make sure you're getting those better rates on qualified dividends. And most importantly, please make sure you've maxed out your contributions to your tax-advantaged retirement accounts if you can. It's one of the best deals out there. So, at the end of the day, it all boils down to a simple question. Are you investing to grow your wealth, or are you investing to grow your tax bill? Paying taxes is inevitable, but overpaying isn't. Once you understand how investment taxation works, you can make better decisions that protect your wealth and help it grow faster. Remember, smart investing isn't just about what you earn, it's about what you keep. If this explainer helped you understand the real side of taxes and investing, make sure to like, subscribe, and share it with someone who needs this knowledge. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.